Hello and welcome to Protocol's event on cryptocurrencies and institutional investors. I'm Tammy Wincup, president of Protocol, and appreciate you joining us. So it's happening. Venture capital firms have started to treat crypto as just another asset class. Now institutional investors are considering allocating part of their holdings to cryptocurrencies. However, catering to these customers will require new tools and tech infrastructure. Are institutional investors ready for this changing landscape? My colleague, Protocol senior reporter Tomio Geron, has a great panel discussion ahead for us to cover all this new ground. And if you haven't already, I hope you will sign up to receive Protocol's FinTech newsletter in your inbox to ensure you are current on all the latest crypto and larger FinTech news. Now I'll turn it over to Tomio. Thank you.
Thanks, Tammy. Well, thanks everyone for joining us today. Really excited about today's panel. And there's so much happening in crypto across the board. And we really want to jump into focusing on institutional investors and what's happening there, because there's so many things that investors are getting into these days. But we really have a great panel of experts to talk about that. So why don't we first just go around quickly and have each of the panelists introduce themselves and say a little bit about their role, and then we can dive in. Grace, do you want to start?
Sure. Thanks for having me. Really excited to be here and honored to be on such an awesome panel with great operators as well. I'm Grace. I'm a principal at Canvas Ventures. We're an early stage boutique investing fund, just under $1 billion AUM. I've been with the team since 2016, pretty thematically driven in terms of my investing style, with a focus on B2B software. More specifically, I've been focusing a lot on Web3 and crypto, in addition to kind of data, AI, ML first plays with past lives in product and growth equity. So thanks for having me.
Great. Diogo, do you want to go next?
Yeah, absolutely. Hi, everyone. My name is Diogo Mónica, and I'm the co-founder and president of Anchorage. Anchorage is a regulated institutional platform that allows institutions to have access to both the prime services and the APIs that they need to build services and products in crypto. So it's great to be here.
Thanks. Walter?
Thanks, Tomio. I'm Walter Hessert. I'm the head of strategy at Paxos. It's great to be here with this panel, and thanks for the Protocol team for having us. Paxos is a company building financial market infrastructure for the blockchain. Our highly regulated platform is used today by the largest technology firms and financial institutions. Firms like Bank of America, PayPal, Mercado Libre, Interactive Brokers use us today as their infrastructure to power solutions for their end users.
Great. Well, let's jump in. There's been a lot of institutions getting into crypto, really big to smaller ones. But I wanted to just get a little more from the panelists about what you're seeing in terms of those investors who are getting in these days. So can you say a little bit about who's actually jumping into the market and what kind of activity you're seeing? Sure. Diogo, do you want to start?
Yeah, sure. Sounds good. I'll go first. So it's a very different market than it was 3 and 4 years ago. 3 to 4 years ago, this was primarily crypto funds, venture firms, family offices. And today we're having very large institutions, asset managers, banks, corporates, fintechs, all participating in the space. What we see that all these institutions that in the last run-up became interested in the space are now finally getting to market with projects that they started back then, or they started during 2020 market bull run. So it's been fascinating to see that crypto is not one thing. Crypto is multiple things. There's 15 different things around product market fit for crypto. We're talking about remittances, we're talking about stable coins and settlements, we can talk about security tokens, we can talk about NFTs, we can talk about the building blocks and the primitives of DeFi, we can talk about store value. So these are all different product market fits that crypto has. And there are institutions now playing in all of them and across all of them. Obviously for the institutional side or the investment side, the market has also evolved such that the majority of the crypto VC, or the majority of the VCs right now are crypto VCs, because a lot of these opportunities are effectively raising tokens, and they all have some kind of Web3 NFT crypto component. On the other side, we're also seeing these institutions actively building on this crypto infrastructure, making use of stable coins, making use of security tokens to either create more efficiencies in this core business or add new products to their product lines. For example, Square adding crypto buy and sell, and Robinhood adding crypto buy and sell, and all these other players actually adding crypto products. So it's not just institutional investors, it's really all across the board right now, people in the space.
Yeah, and I'll add to that, right? I think the why now is particularly interesting. Crypto has existed for a few years, before today, right? And just seeing the increased adoption driven a lot socially by NFTs, trading card, gaming, an increase in verified users. I heard that on Goldman's website, like the #1 search term is crypto right now. So institutions are actually feeling the pull, in addition, from their user base wanting to get greater exposure to these assets. From the VC perspective, which is what probably I can speak to best, especially, fintech infrastructure or financial native funds and or gaming specialist funds. There's natural extensions there to branch into DeFi, especially some of the topmost layers, like where Anchorage and Paxos are playing on regulatory compliance, custody, et cetera. And then gaming wise into kind of the, play to earn guild education spaces as well. But, it's been a massive explosion, particularly given kind of the increase in kind of excitement around NFTs and others.
Yeah, I'll pile on there. Everything that they said, I agree with, and we're seeing the same at Paxos. Certainly a high growth in the interest and demand for crypto from institutions. How that manifests itself in our business is as the infrastructure layer powering these B2B2B and B2B2C type solutions for some of the largest financial services and technology firms in the entire world. We're seeing more and more of those types of firms come to the table and saying, hey, our customers, our end customers, whether they're retail customers or in the case of financial institutions or broker dealers, those end customers could be institutions and businesses themselves. They're saying our customers want this right now, and how do we bring this product to market? And so we're seeing just enormous growth in demand. I would say that PayPal is very much the start of this wave from our perspective of all of these firms moving in and saying, hey, we need to have something in place for our customers because this is a product that they want today. This is an asset class they want access to today. And so we're seeing that continue to accelerate week over week.
Yeah, definitely. So I think there's there's several different examples you mentioned there, from corporates who have end consumer customers to more on the investing side. In terms of those institutional investors, can you talk a little bit about how they're getting into this market? In terms of from everything from outsourcing this to hiring their own people. Do they have managers? And what's the on-ramp, if you will, to getting into the market?
Yeah, I think Diogo probably has a unique perspective serving a lot of these clients, directly. So interested in your perspective. One thing I could say is that a lot of these types of institutions have had access to crypto exposure for a long time. The easiest way to do it has been through funds, let's say a private investment in a fund that was investing in crypto. But that's shifting very significantly and quickly, where you see, all of the bulge banks have been public about, they're building their digital asset teams, et cetera. And I think everyone, if they haven't been explicit about it, everyone understands that the banks are getting to the place where they can offer these products. And so what we're going to see and what we've started to see, I think, is a shift to where it's no longer just easier to invest, make a private investment in a fund, but now it's just as easy to trade it yourself. And you'll be able to trade it through the largest financial institutions that you already trust with this type of activity, whether it's your custodial services or for your execution. The same types of players that are serving you in traditional other types of markets will be able to serve you for crypto trading in, from the same firms.
I'll jump in and say the following. It started out by being, let's actually give the money to the people that know what they're doing. So 4 years ago, 3 years ago, those were the crypto funds. So let's actually fund funds and make sure that we have exposure to the crypto space by giving it to managers that are on the ground. And then it started by being direct allocation, maybe with some of these traded funds, the GBTCs of the world, direct allocations, but still with shares and not on the underlying. And then it went directly to owning the underlying and having the custodial capabilities, the execution capabilities still on the underlying. And now it's gotten to the point where every single early stage company that they're raising, that is raising on a token aware safe, or is raising on a token round, or as some kind of token partnership or strategy. And so it's forcing a lot of these investors that are just traditional investors to actually have to receive tokens. So we get a lot of these institutions that come to Anchorage and say, hey, I'm about to receive tokens from an investment that I did that was equity that now has a token component. Or, hey, I'm an LP in X funds and I'm about to receive an in-kind distribution that I have no idea what to do with. And so it is funny because it is not just about institutions that are coming into crypto. They are directly forcing the second hop to also come into crypto. Great examples are, say, the FDIC right now. If there's an financial institution that goes bankrupt, they are forced to deal with crypto. The DOJ, if there's criminal activity in crypto and they're seizing assets, they have to force to deal with crypto. If there's an endowment and the endowment is receiving highly appreciated donations from their alumni network in crypto, they have to deal with crypto. So it's not just the people that want to deal with crypto that are dealing with crypto, it's everybody else that is being forced into it.
And that's just why I double click on is so many people are being forced to deal with it, but don't know what to do, right? And still there's huge, adoption curve, especially just on the institutional VC side, or even really tech savvy folks are not sure how to navigate this landscape. So I think we still have a long way to go, both in terms of UI UX and just greater educational and consumer awareness to get institutions on the same plane from all variety of things and how to deal with it, how to protect themselves, how to custody, et cetera.
Do you think that on that educational point, do you think that there's enough information even for investors who, I guess that's a good example. If I'm getting crypto from one of my companies, what do I do? If they're, jumping in tomorrow, what's the, how do they, besides setting up an account, like what's the educational factor there?
I don't think there is a really good path right now that's widely known. I mean, I'd be curious, maybe there's resources on Anchorage or Paxos' website that people can go mine. But right now, how I have gone into the space, and a lot of my friends specific to the VC side are just talking to other people who are smarter than the space and gathering resources that way.
Yeah, maybe I'm biased, but I'll say that whenever a client comes to us and says, hey, I have this thing, we usually explain what the thing is, why it makes sense, and how to safely custody it, how to safely execute it, whether they want to sell it or keep it. And in some cases, what does staking mean? You have this asset that generates 20% yield on a yearly basis. You can either choose to sell it, but you can also choose to generate yield out of it. What are the tax consequences of such decision? What are the audit consequences of such a decision? What are the types of partners that you can work with? And so we really give them just a full service, vertically integrated of, we are the platform that can take it on, but can also show you what your options are. And yes, we are not telling them how to do their investments, and we're not giving them investment advice. There was some kind of theory behind their investment in the first place, and now they're receiving these tokens as a reward for it. We just help them make sure that they safely keep them, they either sell them or keep them, and are able to generate yield off of them. So I would say that we do a pretty good job. The hundreds of clients that we have on the platform, I think would agree.
Yeah, it's actually a great question, Tomio. I think that when you think about the stage of adoption that we're at, and this kind of mainstreamification that continues to happen and is fueling or is happening in parallel to the demand of the growing demand from institutional investors, we're at the stage where we passed maybe like the early stage, which it was proof of concept, right? Or, we know the stable coins can be enormously valuable. We know that Bitcoin is actually a great store of value. And so what we're at right now in adoption is really, it's synonymous with education. It's with education and access. And that's what's happening, I would say, at a better and better by firms like Anchorage, by firms like Paxos. At Paxos, I know that when we have these large clients that are coming into the space, they often come to the door saying, hey, we help us learn more about this, help us understand this better. What are some of your other clients doing? How should we be thinking about this? And what we often say at Paxos is we'll go on that journey with you. So let us be a resource. And it's really important at these huge institutions start building these types of products. It's not just a small, tweak to their platform or a trivial new functionality that they're adding. It's a big deal. And so they want to do it the right way. They want to do it thoughtfully. And education is an important part of the process. And it's very much our responsibility to do that in a thoughtful and responsible way. And it's something that we do also take a lot of pride in, kind of going along that journey and being that educational resource to these types of clients.
Yeah, definitely. Diogo, you talked about that sort of evolution from managed funds to perhaps investing directly. I wanted to ask you and the panelists about just what these institutional investors are actually investing in these days, and if that's evolving from just Bitcoin, Ethereum, altcoins, DeFi, NFTs. Do you see that sort of evolution or spread happening to other assets, or is it still fairly focused on a few?
Yeah, I'll say that Bitcoin is still by large the biggest asset, of course, because it's been in market for so long, because it has been so well trotted. There's the one that has the most liquidity, the one that has the most technical solutions for custody, execution, et cetera, et cetera, et cetera. However, there's very few of our clients that actually only own Bitcoin. And again, we can go back to why that's happening. But from an investment perspective, people are definitely looking at these other assets as the highest potential assets. Very few people believe that Bitcoin has 1,000x run left in it in terms of price appreciation. But if you look at a Solana, or if you look at one of these new assets and you realize that you could have had 1,000x in the past 3 years, then all of a sudden you are heavily incentivized to go look for these new projects as the source of your fund returns. And so that is already actively happening. So I would say it's barbell. If you are an investor and you're looking for very high appreciation, then you're going towards a bleeding edge, investing in new networks, privacy networks, investing in DeFi protocols at day zero. So you are doing early stage investments to make sure that you reap as much of the upside as possible. On the other side, if you are a very traditional financial institutional investor, on our platform, we have endowments, we have sovereign wealth funds. Those are a little bit slower in terms of adoption, but even those have moved past Bitcoin. And part of the idea there is that once you do have a partner that does custody, does execution, the staking, does governance, is regulated, then all of a sudden it becomes very easy. It's very hard to go from 0 to 1, from 0 to Bitcoin. But once you go from 0 to Bitcoin, it's very easy for you to go from Bitcoin to Ethereum, then from Ethereum to everything else. Because the partner that you have, hopefully the partner that you have, already supports these hundreds of assets, and thus allows you to not have the platform dictate the investment strategy of the clients. So that's what I see. People get comfortable with one asset and then very quickly move on from that asset, either because they want to do capital preservation and they believe in Ethereum also as a capital preservation asset, or because they want higher returns. And so they go to support networks on seed stage that are up and coming.
Yeah, I think, Diogo really covered. I think that's right. I would say maybe at a high level, just to think about it, in the early days, it was very much, Bitcoin maximalist versus the rest of the world. It was like Bitcoin or bust. And so that is a natural place. And given kind of the other dynamics of the asset and the size of it, where institutions originally focused and still a majority of their assets sit. And if you look at all of the solutions that we power as infrastructure for our clients to power these solutions for their end users, many of them are still starting with, hey, let's just start with Bitcoin, or let's start with Bitcoin and Ethereum, and then we expand to others. And I think that, the institutions started to see all of the people developing on Ethereum. They started to understand what that means. And so, there started to be an interest in investing in Ethereum. And I think over time here, these different protocols start to look more like stocks, and institutions can start to value them or develop a belief of what that protocol can deliver. So today, most of the exposure is still Bitcoin and Ethereum, but you have other L1s that are like Ethereum that might scale better, like Solana, of course, is a great example where you're starting to see a real desire for exposure as well.
Yeah, the only thing I'd add is just diversification increasingly, right, across stable coins, more exotics, et cetera. has been kind of the name of the game, especially as people are seeing, much more real and realized returns in terms of APY versus US like 10-year treasuries, for example, right? Like an average stablecoin that's like low risk is like 2 to 12%-ish, right? You can get an exotic coin with over 250% APY return. I'm yield farming in a few that are 50% APY, right? And so the realized value is increasing that inclination towards diversification of assets as well, beyond just crypto, traditional ones like Bitcoin and Ethereum.
Yeah, and to Chris's point, I'll just point out that has very much replaced the crawl and the crawl, walk, run that was crypto. The crawl used to be take a position out of your balance sheet into Bitcoin for capital preservation. Now the crawl is wire Anchorage US dollars so we can generate 7 to 9% a year on your cash. And the only thing you need to be comfortable with is the fact that there's collateral that is crypto collateral. And we do the custody, we do the monitoring, we do the automatic liquidation. That's what you have to be comfortable with. Not exposing yourself to the volatility, not exposing yourself to asset risk or protocol risk, but exposing yourself to Bitcoin as collateral, which, by the way, Bitcoin is fantastic collateral. Trades 24/7, highly liquid market. And so it's a fantastic way to get exposure. So that has been the crawl. And that has really gotten popular in the past 12 to 18 months. And it's one of the fastest areas of growth of our business is wire us dollars. We'll wire some more dollars back.
Yeah, for sure. We talked a little bit we touched on altcoins, and to the extent that some of these investors are trading, maybe they're just, like you said, sending it to Anchorage or Paxos and holding it. But I wanted to ask you about gas fees and throughput. And, there's been a lot of talk about layer 1 versus layer 2. I think we talked about this little, Grace. Is there a move to considering some of those other assets because of those high fees or issues with especially Ethereum these days?
I mean, yeah, right. It's a key consideration. Gas fees are exorbitantly expensive, right? And there's a movement to believe, especially as we get to Q1, Q2, 2022, and more transition to layer 2, there'll be, an interesting decrease of that. But it's a key consideration to take in any trading decision right now. And so gas fees are massively expensive. And so it actually does encourage you to trade in larger amounts and or, in a slightly more regulated way than just, a few $100 now and then, given the exorbitant gas fees, especially if you're swapping different coins and such.
Yeah, I think that the gas fees are certainly leave a lot to be desired at the moment. At the end of the day, the trading of this asset is really trading in many ways the value of the network and the future value of the network. And the network should be more than just the trading of those assets. Certainly, I think everyone here on this panel believes it will be. One of those exciting use cases would be payments for goods and services types of use cases. And that's just not something today that's possible using, let's say, Ethereum, for example. But you start to utilize Solana, for example, or other high throughput blockchains, and you can actually start to solve for that in a meaningful way. So today we power for MasterCard the infrastructure for the settlement of stable coins into their network. That's just the settlement side of it. But soon I believe that this is this innovation and the infrastructure to enable it is happening at such a rapid pace that I think we're going to be watching a very, very exciting space evolve in the payments for goods and services with these digital assets this coming year in 2022. It's really starting to be enabled so that the actual payment itself can move on the blockchain. And I think that that's something that we're going to start to really see change in a major way this year.
Yeah, I'll just point out that there's other dimensions in which these assets are kind of positioning themselves. Some fortunate, such as fast finality, so our blocks get minted in seconds, or very low gas fees, which are great. They're technical solutions to real problems. Some of them less fortunate. They're trying to bend on this narrative of energy consumption, and we are the green solution. And those are less fortunate because I think in crypto, everybody realizes how misguided that view of the world is, but they're trying to a little bit draft on the fact that they're green blockchains or something of the sort, which is funny for a blockchain to have a color, but they're green blockchains. And so there's a lot of other dimensions that actually work with financial institutions, that actually work with the public at large, they work in terms of public media. And ultimately, the thing that you have to realize is that the thing that will make these blockchains work is attracting developers and attracting use cases. And the way that you attract developers and attract use cases is by having obviously a great PR department, a great community, and a great set of ecosystem around you. So any kind of narrative that you can tack on that makes your asset be better than the other assets, there's a very fierce competition for all these layer ones and layer twos, roll up, scalability solutions. There's, I would say that at least 150 viable ones trying to fight for primacy.
Yeah,
I think
definitely.
Another one, and maybe just a deal that like another really positive feature of some of these L1s that you see trying to be solved for is like the privacy and audibility, which becomes more and more important as we start to see these assets used for things beyond just the trading themselves.
Yeah, and I'll add one thing, which is, more philosophically, one of the reasons why crypto is succeeding and why this space is moving so fast is because the pace of iteration is effectively unbounded. The iteration is infinite. The amount of money being poured into the space is effectively looks like it's infinite. And the amount of talent coming to the space is unfortunately finite. However, it is incredibly, incredibly large in terms of numbers pulling in. And if you have incredible talent, lots of money, and ethos of actually iteration and getting as fast as possible with something to market that works really well and finds a real product market fit, this is part of the reason why this is such an exciting space and why all of the investors are coming to crypto in Web3, because this is where the innovation is at. And this is where the future very large companies are going to be. And they're looking at this as, a little bit of a retiring of the old guard. And to the point Walter that mentioned around security and privacy, it's also about data ownership. It's also about ads as a business model versus potentially a new type of business model that is more aligned with the consumers. It's a lot about these things that are just fundamental changes in how the current protocols and the current internet actually works that are happening on the ground, and why people are so excited to invest.
Yeah, on that point on privacy, security, and kind of auditability, it kind of touches back on the education question. But do you think there's adequate research now these days? If you think of these coins as stocks, is there research, or are the banks now going to roll out research on individual protocols, or what do you see on that level?
I see it coming really quickly. I see some of the banks starting to do it, setting up teams that are just dedicated now to digital assets. I know Bank of America has a research team that is now focused just on digital assets. So I think absolutely you're going to see it from the banks. And you're also going to see it from new companies that start up, to Diogo's point of the decentralized nature of the innovation and the innovation cycles here. We're going to see types of data companies, not just going to have to come from banks. It's going to come from a whole bunch of different types of companies in really meaningful ways. And I think that's actually a really exciting area of innovation as well.
Yeah, I just add that it's important to develop your own framework here as an institution or as a VC or whoever you are, as you invest in either different companies, different tokens, et cetera, and having that framework, diving deeper into the project, the backers, the founders, the white paper, et cetera, and really doing your own research is still very important here, just as if you were investing in a stock and having an educated thesis, hopefully, into why you think that asset will appreciate over time. And there's some specific things like seeing like the market cap, for example, of token relative to Ethereum, or the ratio of like circulating supply of the tokens today versus total available supply, and specific things that I think will become more widely known and educated, in part due to the work of like Anchorage, some of the banks, Paxos, et cetera, getting the word out there.
Yeah, I also want to mention that education is not just about the investors. In fact, a big portion of education is with the regulators, especially if we talk about privacy and we talk about anonymity and if we talk about some of these aspects of these protocols. There's constant communication that needs to be had with the regulators, something that we've been doing for the past 4 years since inception of the company, really walking them through what these technologies are, why they're special, why they're new, where are the risks, where are the advantages, and obviously finding common ground with the current regulation and pointing out where the current regulation might not be sufficient and where we might actually need new regulation. So that's a huge, huge component of education, is the education of the regulators.
Definitely. And Diogo, I did want to ask about regulation anyway. Do institutional investors have concerns in terms of, hey, I want to invest in crypto, but I'm worried about the regulatory risk. not just the fact that obviously you talk to them, but new laws, Gary Gensler, whatever could be coming down the pike. What are you seeing there in terms of those concerns?
So again, there's many constituents in crypto. We can focus on investors for a little bit, but even on the investors, there's many different types of regulatory risk. In the beginning, there was risk around custody, just basic things around, does this partner meet qualified custodian status, yes or no, such that I can actually invest. And there's these laws that force RIAs, at least within the United States, to custody with a third-party qualified custodian. So in the beginning, there was just, some uncertainty around, can I even hold this asset or not? I think we're past those types of basic components. We're also past the liquidity, some of the liquidity questions. Can I execute this? Can I actually get in and out of large positions in these assets, yes or no? So some of these have already been solved. But again, I'll point out that crypto is not one thing. Crypto is not Bitcoin. Crypto is not Ethereum. It is multiple 15 different things that have all of them different regulatory aspects and different degrees of gray area in terms of how clear the law and the regulation is around them. Stable coins, that's one bucket. You can talk about security tokens as another bucket. You can talk about these commodities that are store of value as another bucket. You can talk about the building blocks of DeFi as another bucket. Every single one of these buckets, we could talk about it specifically about where there's regulatory clarity, where there's lack of regulatory clarity, where the industry has already made so much progress to make these institutions be comfortable with it, and where the industry needs to make more progress so that institutions are comfortable with investing. In general, institutions were worried about custody. They're no longer worried about us. Liquidity, they're no longer worried about it. They were worried about qualified custody status. They're not really worried about it. Now there's some questions around these headwinds, which there are headwinds in the United States around the regulators taking a look at these stable coins, the regulators taking a look at DeFi, the regulators being very concerned about things like travel rule and meeting the travel rule that has an equivalent in traditional financial world, for which cryptocurrencies just don't cleanly fit into those kinds of issues. And then we have the industry solving those problems. Some decentralized solutions for it, some centralized solutions for it, some just regulatory solutions for it, working groups to try to solve them. I do think that the investors look at it as a potential source of risk, but they have seen the past 13 years of cryptocurrencies. They have seen the industry move past these goalposts in a very progressive manner, in a very methodical and constant manner. And so I don't think they're afraid. They definitely see it as a risk, and they calculate it into their investment thesis of whether something has regulatory risk or doesn't have regulatory risk before they invest. But I would say we made so much progress so far, and it's actually incredibly surprising. If you look at it 4 years ago, when we started Anchorage, if you had told me that we would have an OCC federally chartered bank custodying crypto assets, an OCC federally chartered crypto bank custodying a CryptoPunk for Visa. Digital art, that is kind of a crazy concept. Maybe CryptoPunks were a crazy concept 4 years ago even, but the fact that there's a large corporate, one of the largest in the world, holding a CryptoPunk on a federally chartered crypto bank, that's kind of an insane concept itself. So we've come so far, and so many of these things have already been solved. And there's obviously still a lot more to solve.
Yeah, one comment I just make, kudos to both Anchorage and Paxos. I think they're two great case studies for the industry on companies that have received trust charters, have done a great job working with regulators. There's other options of companies in the space that maybe haven't done quite the same. And so I think we're going to continue to see more of that as folks dive in. I think two things to point out. One is that regulations are different in every country. And in fact, in the US, there's different across different states as well. And so I think in order to invest more in this space, you just have to be aware of that and understand that, it can easily shift between geo or location, depending on, new regulatory action that comes out of the US or Canada or Europe, et cetera. Also that just DeFi is decentralized and it's hard to regulate in a single jurisdiction in general, right? So I think that's another important piece to point out. But I think exactly what Diogo said, right? A ton of really exciting progress has been made. The US recognizes cryptocurrency as an asset. They view tokens as a security. And so there's a lot of exciting steps, although a lot more regulation will probably still be down the pipe to come. The headline here is crypto isn't going to go away. It probably will just have increased regulatory framework over time, which will probably just make it safer and potentially easier for more investors to get involved that may not have the know-how or knowledge to do so right now.
Yeah, I think it's both great points. I mean, we have Paxos was founded in 2012. And we have been working hand in hand with regulators at all different levels since then for nearly a decade now. And we have, really proud to have set up what is the, one of the most regulated platforms in the digital asset space, with a New York trust, a federal trust bank from the OCC, a no action letter from the SEC pursuing other license there. So really a lot of heavy regulation and licenses have gone into this, and it does matter. I would say it matters in a really big way. So not to make light of the accomplishments of Diogo and his team, or all of the work that we've done at Paxos over the last decade, because it goes a really long way. And I think that when you see these huge firms coming into the space, the largest firms in the world, there's a whole bunch of different companies out there that can provide the technology solutions. But in financial services, platforms are regulated. That's what financial market infrastructure is a highly regulated platform. And so it's been really an important value proposition, important distinction for our platform when we're out there talking with these clients. And I would say it's one of the most important things. It's just that we've gotten to a point where a lot of the boxes are checked. Now, it's important to mention that, per Diogo's comment of these are all, can be different in the market. This is not all the same to everyone. The clients are not all the same either. There are different flavors of what they need and how their regulators are kind of allowing them to move into the digital asset space. You could have a global fintech with just operating off of, from the US perspective, on just MTLs. You could have a large FINRA regulated broker dealer. You could have a Fed regulated bank. And these are all very, very different stakeholders that you have to work closely with to bring these products to market. And Paxos has all of those types of clients today. And so I would say that it is really important, and there's a lot of work still to be done, because it's not just how we're regulated as a firm, but it's also about how the partners are regulated. And that requires close collaboration and education, not of the partners, but beyond that, again, to the regulators.
Right. It sounds like even if you're doing everything right, which I don't doubt that you are, this is not a simple thing to just check a few boxes and and you're up and running, right? It's there's different regulators at each level that people need to be aware of.
Absolutely. Yeah, it's all part of the education that's happening right now in the market. And I know at Paxos, we feel like, as a major player in the, an infrastructure provider in the space, that it's a responsibility that we have to be able to provide this type of education to the regulators, because ultimately what we want as a firm, and what we frankly think that the whole market wants, what we know our clients are asking for, is clarity, consistency, and certainty in that regulation. And so we are trying to work with regulators to make sure that gets done in an effective and responsible way.
Do you expect more regulatory clarity in 2022? I know that's what everyone in crypto wants, or most people. Do you expect that next year?
Maybe I'll go first. I'll say the following. I expect more regulatory clarity every year, but I also expect crypto to move faster than what the regulation can keep up with every year. And so, I think the interesting thing is that crypto is moving so fast, and it's moving into such different directions that it's very hard. I don't envy the job of a regulator that has to keep the market structure functioning, that has to protect investors, while at the same time not stifling innovation in the United States and dealing with a market that is changing on a daily basis. It's very hard to keep up with the market, even for firms or institutions like the ones on this call that are effectively crypto specific and spending 100% of their time in crypto. Even for us, it is hard to keep track of everything that is happening. And so regulation is going to follow the same path. More regulation will come in, it will have clarity year over year that will be more clear, but there will also be new offshoots and new ideas and new things to regulate in the future that crypto will come up with.
Yeah, I agree.
It will be just as crazy.
Yeah, very crazy, right? But in some ways, I think it's going to be, not dissimilar to how DeFi developed, but more of like these building blocks or Lego blocks over time. Like, I think we'll probably immediately see more investor protections, fraud protections, registration of securities built on top of one another until I don't think there's necessarily going to be a sweeping, clear, framework that encompasses everything right away. It'll take much more time.
Definitely. So then, I definitely have to ask you about DeFi, since that has been a big area over the past year or two. So is there a way for institutional investors to get into DeFi? Are they interested in that? Are there ways to make it safer for them?
Yeah, I'll jump in and say they're absolutely interested in it. The top line yield is interesting to everyone, right? Whether they're consumers or whether they're institutions. So the answer is yes, a lot of interest, very interested. Institutions take a little bit longer to get there in terms of comfort, of course, because a lot of these things are new. Institutions look at smart contract risk as something that is new to them, that they have to deal with. And there's not a lot of insurance solutions that can really cover all of their assets on these platforms and really cover completely the smart contract risk. There's obviously institutions on the bleeding edge. There are making bank by actually being there first and taking on these risks, but everybody else is interested. And the things that you need is the things that you need for traditional investment. You need a safe platform that can do the staking for you, that can do the governance for you, that can do the participation for you, that can do a clean, beautiful UX experience that allows you to not shoot yourself in the foot. A platform that is regulated, a platform that has insurance, and a platform that has these abilities for all the assets that you want to participate. And so that's what they come to market, and that's what they ask of Anchorage, and that's what we provide them. And what happens, though, is that obviously there's always constant demand for us to support more and more DeFi protocols. And Anchorage obviously has to always look very clearly and use our asset support framework to decide which of these protocols and which of these use cases we can support and should support. And that's one of the benefits of being institutional players only. We don't have any pressure to support, the latest dog coin or whatever it is that is coming down to the market, because that's not our business. Our business is just to work with very sophisticated institutions and provide them the things that they want to invest. So yes, there's interest. Yes, a lot of institutions are already in, but they are all the most risk-seeking on the curve. And the other ones are here, they're looking, they're exploring. Maybe some of them already have some of these things up in the lab, but this is not mainstream yet.
Yeah, I would just say, if you I think that's right. When obviously retail, there's little enforcement possibility if they partake in DeFi at the individual level, and you see corporates getting into it with some of their treasury. I would say on the certainly on like the SMB side, and then when it gets into the banks and the types of clients that we are powering infrastructure for today, I would say that it's very much, in the stage that Diogo said, which is high interest, really want to understand it better. Hey, how come in the market, how come the Fed fund rate is under 25 bips, but I can hold dollars here and get 7 or 8%? What does that mean? Trying to understand it. And of course, they want regulatory clarity. There's been a lot of headlines, and you're not going to see a, $100 billion plus, public company and probably, other much smaller companies as well move into DeFi, try and generate yield before they have some sort of regulatory clarity.
For sure.
And then, by the way, maybe on this DeFi, I don't know, Grace, if you want to say something, but let me just point out maybe a little bit of a rant. I want to point out the following. I want to point out that in DeFi, we have inadvertently created an expansion of reach for the US dollar. 95 to 99% of all DeFi is done in US dollar. Whether it's done in the United States or abroad, it doesn't matter. All these stable coins that matter are all US dollar denominated. So we've inadvertently created an ecosystem of the internet that is probably one of the fast technology phenomenons out there, that is based on the US dollar, that is iterating really, really fast and creating a lot of innovation. And so let's recognize the fact that the dominance of the dollar can only benefit if we allow this protocol and these DeFi protocols to benefit from the growth of using the US dollar versus fighting that phenomenon. So I just want to rant a little bit to say we have created ourselves a tool as Americans to expand the reach of the US dollar. Let's not shoot ourselves in the foot and stop it from happening.
And I would add to that, expand the reach of the US dollar, and in doing so, provide more financial access, more financial freedom, and more financial security for the global population. And to that point, we power a regulated stablecoin. Again, we're a highly regulated institution powering a stablecoin that's approved and overseen by our primary regulator, the NYDFS. That was just launched last week into the largest e-commerce company in Latin America, Mercado Libre, where their clients in certain markets can now buy that with their local fiat currency, and they can effectively have access to US dollar bank accounts. So I do agree with Diogo here. It's an amazing innovation for the US dollar, for the United States, and really for the global population. It would be, I think that it's one of the very exciting areas that we're going to see develop in 2022. And we're really excited to see the way it continues to expand into the mainstream. It's an amazing development for the US dollar.
And just one thing I'd add is the growing maturity of the DeFi ecosystem and the pipes and the growth of custody, identity, regulatory that has developed is one of the reasons why I'm extremely bullish on crypto going from an investment perspective. Even as we'll see continued price fluctuations on some of these assets, the underlying ecosystem is getting much more mature, which bodes very well for the future and just for safer custody, execution, security, liquidity aggregation. We'll see, increased steps towards more people getting in the ecosystem as a result of that. And from institutional perspective, I think DeFi has a lot of parallels to financial infrastructure. And so we'll see a lot of investors move into that space and grow and build. And a lot of developers also continue to grow and build in the space as well. For
sure. I did want to follow up on the stablecoin point, Diogo, because I agree on the one hand, but I feel like stablecoins do present risk, and people have said like stablecoins could present systemic risk if they're not, say, regulated, like Paxos, for example. But there are big ones like Tether, et cetera, that may or may not be backed by US dollars, as well as much smaller ones that are not necessarily backed by dollars in their treasury that have been popular recently. So yeah, I'm just curious, like, do institutions see stable coins as kind of low risk US dollar investments, or are they kind of getting in there because it's a higher, 10%, return they're expecting, and that sort of more of a riskier investment?
I just want to say that the fact that exists one stable coin that clearly does not fit the definition of what a stable coin should be and does not fit the regulatory clarity that we wish a stable coin to have, it is not proof that all stable coins are not regulated and not legitimate. So let me just point out that the majority of the stable coins that are used in the United States have all of the bells and whistles. And in fact, they don't present systemic risk because they're backed one-to-one by the US dollar. So in fact, there can't be a bank run or a run on the bank for a stable coin because there's treasuries in dollars backing it. So there can't be a run.
But if it's not backed by dollars.
Right. And so that's just a definition. Let's call a stable coin something that is actually backed by dollars. And then the conversation is very focused and very scoped.
But if 50% of the market
agreement that it needs to be regulated, fully 100% agree that it needs to be, not in the US. The market in the United States is not the case. The market in the United States is not primarily using USDT. It's actually primarily using USDC. And so which is regulated itself, and it is backed one-to-one at this point. So
I do think
regulation, yes, we need it to be regulated. We need it to be clear. We need it to be backed. We just need it to happen and for the innovation to continue to happen. So instead of using
important to differentiate between backed and regulated, because USDC, they have now been, forthcoming and transparent with how they're backed and how they invest the reserves. But that does not mean it's a regulated stablecoin, and it's not regulated. The difference between USDC and Paxos stablecoins, BUSD and USDP, is that our stablecoins actually are approved by a regulator and have an overseeing regulator that oversees our assets like they would oversee, different types of banking activity. And so there is an important distinction, and I think it is an important distinction for us to recognize as we enter this period of seeing stablecoins used for payments for goods and services, all the types of things you're seeing used on your platform, that being regulated and being backed are different things, and Paxos stablecoins are uniquely regulated in the market.
And I would even say that we're totally fine with the fact that, there is a bank charter, a federally bank charter that can custody these things. And so we're also totally fine with the fact that if that needs to be the standard, the high watermark needs to be an OCC overseen federal charter, then that's fine for custody, for transfer, for settlement. That is a fine outcome here.
I think
the thing that we don't want to do
is the piece, though, is in the issuance.
Right, issuance and custody, so safekeeping, issuance, settlement, all of these things are traditionally regulated activities, and it's fine that they have clear regulation of where they need to sit in the United States.
Can I just say we need another panel just on stablecoins then? It seems
like
we have a lot to talk about, and we have a few more minutes. But yeah, like I guess maybe but seriously, we probably should be wrapping up actually. So maybe do you have some final thoughts on what you're expecting, in the coming year, especially in terms of the larger institutional investors and what we'll be seeing? We'll be seeing a lot more. Are we going to see more players jump in, or more bigger products, or what are you expecting next year?
I can lead. I think it's only going to continue to be more and more real. I think it's more a question of how quick market adoption and uptake is, and that will probably be predicated based on both UI, UX, and education, as we discussed in pretty great length, but also around a lot of the regulation, compliance, custody, et cetera. I've been spending a lot of my time on the identity side, so we didn't get to talk about that, but very excited for more opportunities in that space, as well as more of the one-click transfer from fiat to crypto to get folks on board more quickly, irrespective of their existing, knowledge in the space. But yes, I'm very bullish. I think we're only going to see more institutional adoption in the next 18 months.
I think that we have a period of hyper growth happening right now, of course, across this whole ecosystem. And of course, there's going to be volatility if you look at the price of certain digital assets at any given point in time. But what we pay attention to is really the fundamentals, and it's really what we're enabling, which is increased network activity, increased access. And on the last point, I think that's something that we're going to continue to see transform. We saw it get enormously accelerated in 2020, in 2021, and in 2022. Paxos will power the crypto buy, hold, sell, transfer experience for billions of end users around the world through our infrastructure partnerships. And so I think that we're just going to continue to see the access accelerate, and it's going to be a really, really exciting year to see the innovation that enables on the chain.
Yeah, what I would say is that, this is not an interesting prediction because it's not a prediction. We're seeing these things happen. If you look at what our client base is, these banks, asset managers, largest fintechs in the world that are currently clients of Anchorage, we see them start these projects. And unfortunately, the projects take 12 to 18 months to get to market, some of them all the way to 24. And so it's easy to predict that something is coming that we see already been worked on because we know it's going to be launched next year. And so, it's not quite a prediction. It's more just saying, hey, this is what's on the pipeline. So it's as much a prediction as any pipeline can be a prediction. There's very high likelihood of success here and very high likelihood of these things actually happening. I think the interesting things are to really predict are the phenomenons that might actually come after, and things that are just weird that are happening in the crypto native ecosystem. And one that I'll mention that I'm tracking personally is the rise of these fiatless banks, these startups that raise funds in stable coins, they pay salaries in stable coins, and they're creating products that are equivalent to non-FDIC insured checking accounts, non-FDIC insured savings accounts. They offer securities. They offer Visa credentials that you can swipe and pay a coffee backed by your actual stablecoin. And they offer points to bootstrap the loyalty. These rise of effectively, crypto neobanks that offer all of these services, obviously not FDIC insured, and they never ever touch fiat. They're bootstrapping, they're growing really fast. And this is just a phenomenon that is happening right now that I think is incredibly interesting, which is a full financially integrated solution for retail that has all of the bells and whistles that you'd expect in a traditional bank to have, but yet never actually touches the euro or the dollar. That is just absolutely amazing and fascinating. And I'm super curious to see to track how these things evolve.
Yeah, that is fascinating. We'll have to look out for that. Well, great. Thanks so much. I think we're out of time, but thanks so much, everyone, for the panel. It's been super interesting and a great conversation. Thanks for doing this.
Thank you for having us.
Thanks so much.
Bye.